Right now, Supermicro trading under the ticker SMCI, is at $33.91. That is a significant drop of $2.51, or nearly 6.9% in today's live intraday trading session. And to be perfectly clear, this isn't a blip. This is a continuation of a brutal, painful repricing. The stock has been in a near free fall, shedding over 30% of its value in just the last month. For a name that was, not too long ago, the undisputed darling of the artificial intelligence boom, the one stock everyone had to own to get a piece of the action, this is a stunning reversal. The expectation was that Supermicro was the essential toll booth for the AI superhighway, a critical partner for Nvidia stock. The reality, as evidenced by today's staggering 7% decline, is that the market is treating it like a low-margin hardware assembler that just got its legs cut out from under it. The moat that investors believed was fortress deep is suddenly looking like a shallow ditch, and the market is panicking. Let's establish the common ground, the narrative that everyone, from retail investors using the Robinhood app to seasoned managers at Fidelity Investments, bought into. The story was simple and powerful. AI requires massive computing power, specifically GPUs from Nvidia. But those GPUs need to be integrated into servers, complex, high-performance, liquid-cooled systems. Supermicro, with its building block solutions, was the master of this. They were faster, more agile, and had a tighter relationship with Nvidia than anyone else. While giants like Dell were still figuring out their supply chains, SMCI was already shipping the next-generation systems. It was the ultimate picks and shovels play. This narrative sent the stock to unbelievable highs, creating a fever pitch of excitement. Investors believed this company could do no wrong, that it was on a clear path to dominating a market set to be worth trillions of dollars. That was the expectation. Now, here is the reality that is crashing down on investors today. That entire narrative has been fractured, perhaps permanently, by the company's recent first quarter fiscal year 2026 earnings report. Today's 7% drop isn't a random newsless sell-off. It is a direct and delayed reaction to the fundamental rot exposed in that financial release. The headline numbers were a shock. Net sales declined year over year, coming in at $5.0 billion compared to $5.9 billion in the same quarter last year. In a market where AI demand is supposedly growing exponentially, a year-over-year sales decline is a five-alarm fire. But the sales number wasn't even the worst part. The real horror show was the margins. Gross margin, the core profitability of what the company actually sells, absolutely collapsed. It fell to just 9.3%. To put that in perspective, it was 13.1% in the same quarter last year. This isn't a small adjustment. This is a 400 basis point implosion. The company is selling its high-demand AI servers and barely making any profit on them. This brings us to the core of the problem, the single biggest reason the stock is being liquidated. The competition has arrived, and they are not messing around. The expectation was that Supermicro's speed and customization gave it a permanent edge. The reality is that scale and price are now winning. We are seeing hard evidence that larger competitors, specifically Dell Technologies, are now fully ramped up and are competing aggressively on price. In its last quarter, Dell reported shipping $8.2 billion in its own AI-optimized servers and, more importantly, announced an $11.7 billion backlog. Dell has the scale, the global sales force, and the supply chain relationships to fight a price war that Supermicro simply cannot win. Reports are surfacing that ODMs are also flooding the market, undercutting SMCI and stealing market share by offering good enough solutions at a fraction of the cost. Supermicro's lack of pricing power, as one analyst put it, is no longer a future risk, it's a present-day disaster. The Q1 earnings report was the proof. The company is being forced to slash its prices to move inventory, and its profitability is evaporating as a result. The institutional sentiment, which was once the bedrock of the bull thesis, has cracked. When a billionaire investor like Philippe de la Fault, known for smart, long-term tech bets, is reported to have sold his entire stake in the company, that sends a powerful signal. That's not a rebalance, it's a vote of no confidence. While you might see some routine insider sales for tax purposes, a major fund liquidating its whole position suggests the smart money has concluded the best days are over. This is likely why we're seeing such aggressive bearish activity in the options market today. Traders are buying puts, betting that the stock has much further to fall. The technicals are a mess. The stock has been officially oversold for 7 consecutive days, which sounds bullish to some, but in this context, it simply means the selling pressure is relentless. The stock keeps falling and buyers are nowhere to be found. Anyone doing their self-investing on SoFi Invest or Interactive Brokers and looking at a simple chart can see this is a classic falling knife scenario. So what does Supermicro actually do? For those new to the story, the company doesn't make the AI chips, it's an integrator. Its business model is built on taking components, CPUs, memory, and most importantly, Nvidia's latest GPUs and assembling them into customized high-performance servers. Their key advantage was their modular building block approach, which allowed them to design and ship systems optimized for new chips faster than competitors. They were the first to market with liquid cooling solutions, which are essential for managing the heat from high-end AI chips. This agility was and is their core value proposition. They essentially provide the chassis for the AI revolution. But what the market is now realizing is that a chassis, no matter how well designed, is still a piece of hardware. And in the tech world, hardware almost always becomes a commodity. The expectation was that SMCI was selling a unique, irreplaceable solution. The reality is that they're selling a box, and now Dell and others are selling a similar box, but cheaper. This leads us to the future outlook, which is defined by a massive tension between two opposing stories. The bull case, the one that management is desperately trying to sell, hinges on one thing: revenue growth. In their disastrous first quarter earnings report, management tried to soften the blow by raising their revenue guidance for the full year, fiscal year 2026. And they also touted a massive $13 billion in orders for systems using Nvidia's new Blackwell Ultra chips. The bulls, and perhaps some analysts at places like Rosenblatt, who recently put a $60 price target on the stock, will argue that the margin collapse is a temporary problem. They'll say it's due to high costs of ramping up new production and customer delays in transitioning to the new Blackwell platform. The argument is that once this transition is complete, the margins will recover. They will point to the stock being oversold and say this is the moment of maximum pessimism, a great entry point for a long-term investment. But the bear case, the reality that today's 7% drop is screaming, is far more convincing. The bears look at that $36 billion revenue guidance and ask the most important question: is it a profit? Who cares if you sell $36 billion worth of product if your gross margin is in the single digits? A Fidelity brokerage account or a Schwab Intelligent Portfolios robo-advisor is built on finding profitable companies, not just ones that have big sales numbers. The bear case argues that this margin collapse is not temporary. It is the new normal. The competition from Dell and the ODMs is structural and permanent. They have set a new, lower price ceiling for the entire market, and Supermicro will never again enjoy the fat margins it had when it was the only game in town. Those $13 billion in Blackwell orders are likely low-margin, high-volume deals that the company had to take to keep their revenue numbers up. The company is in a trap. It must sacrifice profitability to show growth. Based on this margin collapse, do you think Supermicro's management overpromised on their ability to fight off competitors like Dell? Comment below. Ultimately, we are witnessing the market's violent, painful reevaluation of a company. The expectation was that Supermicro Computer was an AI tech monopolist, a high-margin, high-growth kingmaker. The reality is it's a high-volume, low-margin hardware assembler